If you have multiple credit cards, it can be a minefield working out which one to tackle first and how to go about it. To be honest, everyone's situation's different, so I'll give you a few different solutions to make sure that I've got you covered. You've already done the tough part, and that's making the initial decision that it's time to pay off your credit cards. My first question to you is, could you consolidate your debt? Now, the APR on credit cards is usually quite steep, so it takes less time to pay your cards off if the interest rate's lower. So let's say you've got 3 credit cards with £1,000 on each of them. If you get a credit card with a 0% interest balance transfer with a £3,000 limit, you can transfer all 3 cards across and really start chipping away at the debt. Make sure that you make a note when the 0% rate finishes and then transfer to another 0% interest balance just before it expires. In a year, you'd need £250 a month to pay that debt off, or £125 a month over 2 years. You just need to work out what's affordable for you. If the thought of keeping track of your rates and swapping cards really stresses you out, the other alternative is getting a loan. It would be a lower interest rate than a credit card, and you can set the payment term. So for example, if you pay it off over 3 years at a certain rate, you can forget about it once you've set the direct debit up. And then you've also got a set date to work towards, and then all your credit cards are paid off. Now, I appreciate that not everyone has access to getting a loan or that much credit. So what other solutions are there? Have you heard of the snowball method? The snowball debt method, also known as a debt snowball strategy, is a debt reduction strategy where you pay off bills in an order from smallest all the way up to the largest. Now, it's often used as a way to manage multiple debts and can be highly motivating because it gives you a sense of accomplishment when you pay off each debt. Here's a step-by-step guide on how it works. Stick with me. So, list your debts from smallest to largest. This should be based on the total outstanding balance, not the interest rate or monthly payment. Make minimum payments on all your debts except the smallest. Now, this ensures that you don't fall behind on your obligations while you're focusing on your smallest debt. Pay as much as possible on your smallest debt. This is where this strategy really starts. So you'll need to pay more than the minimum payment on your smallest debt, and then use any extra money that you can find in your budget. Roll over what you were paying on that debt to the next one. Once your smallest debt's paid off, take the money that you were putting towards that debt and apply it to your next smallest debt. This is the snowball effect. As each debt's paid off, the amount of money that you have to put towards the next debt goes up, it increases, helping you to pay off your next debt faster. Keep repeating it until all the debts are paid in full. So repeat the process of paying as much as possible on the smallest debt and then rolling that payment to the next smallest debt until all your debts are paid off. The advantage of the snowball method is a psychological boost of paying off a debt in full, which can give you a bit of momentum just to keep on going. However, it is worth noting that this method doesn't always save you the most money in the long run. If you do have debts with significantly higher interest rates, you might end up paying more in interest over time. The avalanche method, which involves paying off debts with the highest interest rate first, may be more cost effective in these cases. But the best strategy ultimately just depends on what motivates you to pay off your debts. So what I've done is I've left you a link in the description to a snowball calculator. It gives you the option to either use the smallest debt first or the highest interest rate. It's totally up to you. If you use the highest interest, that's a more cost-effective way to pay your debt off. It just depends on what works best for you. If your credit card debt is much higher and you're struggling with your payments and don't really know where to start, then you may want to consider something like a debt management plan. What is it? Well, a debt management plan is a structured repayment plan set up by a credit counselling agency. It's designed to help people who are struggling with unsecured debt like credit cards to repay their debts in a manageable way. So let me explain to you how this works. First up, you have a counselling session. To start a DMP, as they call it for short, you'll typically have a counselling session with a credit counsellor. They'll review your income, expenses, and your overall financial situation. The next step is to create a budget. So based on this information, you'll work together to create a realistic budget that accounts for all of your necessary expenses. Negotiate negotiation, the credit counselling agency will then negotiate with your creditors on your behalf, and they'll try to lower your interest rates, waive your late fees, and create a payment plan that fits within your budget. Single monthly payment. So instead of paying each of your creditors individually, all of your 3 credit cards or however many you've got, you'll just make a single monthly payment to the credit counselling agency. Then what they'll do is they'll distribute the funds to your creditors according to the payment plan. So with regards to the plan duration, DMPs usually last between 3 and 5 years. And during this time, you may be asked to close your credit accounts and not open new ones until you've completed the plan. Education. Many agencies also provide some educational resources to help you understand budgeting, saving and credit, just so that you can manage your finances a little bit better in the future. It's important as well to know that while a DMP can be a helpful tool for managing debt, it isn't for everyone, and it can also have a negative impact on your credit score initially. And if the DMP requires you to close your credit cards and credit accounts, that can also affect your credit score, and you'll also need to be able to stick to the payment plan for several years. The most important thing with this as well is that you go with a reputable company. So I'll leave a link to a form below the video. It'll ask you a few multiple choice questions and then connect you to a company that I've partnered with to give you some sound advice. I hope that's helped you have a bit of clarity on how to pay your credit cards back. Like I said at the start, you've done the tough part, which is making the decision to pay your credit cards off. Once you've worked the logistics out, you'll be well on your way to becoming debt-free. Good luck.